Imagine the moment the market opens and the first trade flashes across the screen. Silver, last night at $73, now marked at $77.50 and climbing. In the big dealing rooms of New York and London, there's a pause that feels much longer than the few seconds it actually is. Nobody says anything at first. Traders stare at their risk dashboards, VAR numbers, margin reports, the blotter of outstanding futures and swaps. The price isn't just higher, it has blasted through a level that, for years, everyone quietly assumed would never be reached without a complete reset of the system. This is the hook, a simple price print that exposes the entire structure of how modern finance has treated silver, not as a scarce industrial and monetary metal, but as a highly leveraged synthetic product. And as that price skips from 77 to 78 and then flickers with a 79 bid, the dawning realization in those rooms is the core of the story. The people who thought they controlled the silver market are suddenly the ones trapped inside it. To stay honest, this is a hypothetical future scenario, rather than a description of something that has already happened. As of my last training data, silver is not traded anywhere near $77 an ounce, yet the mechanics that would make such a move possible are very real. For decades, a small group of large banks and trading houses have acted as the primary dealers and liquidity providers in the global silver market. They dominate exchange trading on COMEX, the over-the-counter derivatives market in London, and a web of forwards, swaps, and leasing agreements with miners, refiners, mints, and industrial users. Much of that business involves being structurally short on paper, promising silver in the future that they do not necessarily hold in physical form today, while hedging and offsetting exposures elsewhere. In a calm, liquid market with stable prices, that model throws off a steady stream of fees and trading profits. But in a sharp, sustained price spike, the math reverses with terrifying speed. Part of the drama on this imaginary $77 morning comes from the way leverage compounds every tick. A standard COMEX silver futures contract represents 5,000 ounces. At $25 per ounce, that contract has a notional value of $125,000. If the exchange requires, say, $10,000 of margin per contract, a trader is effectively using more than 12 to 1 leverage. That is manageable, while prices move gently. But if silver has been squeezed relentlessly higher and now gaps beyond 77, the same contract is suddenly worth over $385,000. A bank short 10,000 such contracts is short 50 million ounces. Each $1 move now means a $50 million mark-to-market swing. That is the arithmetic you see reflected in the ashen faces on the trading floor. The banks are not just wrong on a trade, they are facing geometric growth in their liabilities. Behind that price print is a deeper structural fact. The amount of paper silver claims far exceeds the quantity of metal that routinely moves in and out of vaults. The global mining industry produces on the order of hundreds of millions of ounces of silver each year, and there are significant above-ground inventories spread among industrial users, investors, ETFs, and exchange vaults. But on a typical day, the sum of outstanding futures, forwards, swaps, and unallocated accounts represents multiple times the metal that is immediately available for delivery. This is not necessarily a conspiracy. It is how modern commodity finance evolved to match long-term producers with short-term consumers, smooth inventories, and provide hedges. As long as relatively few holders ever demand a physical delivery at the same time, the system can roll, net, and cash settle most obligations. But when confidence is shaken and a rising price makes everyone less willing to part with real bars, the comfortable assumption breaks down. The suspense in this story comes from the collision between that leverage and a shift in investor psychology. For years, the banks have assumed that if prices rose too far, they could always find enough willing sellers, miners locking in forward production, ETF managers adjusting their holdings, speculators taking profit. But imagine a situation where, for reasons we will explore in depth, the marginal holder of silver no longer trusts paper promises and refuses to sell physical metal in size at any price the banks can live with. Now the short desks are staring at a wall, obligations to deliver on one side, a vanishing supply of offers on the other. Every uptick forces them to buy back some contracts to limit the bleeding, yet those very purchases push the market further up. This is what traders mean when they say a market has gone no offer and shorts are trapped. The panic buying we're imagining is not greed, it is survival. In those first hours above 77, the mechanics of the trap express themselves through the margin system. Exchanges and clearinghouses monitor volatility and credit risk. When prices move dramatically, they raise initial and maintenance margins. For a heavily short bank, that means wiring in more cash or eligible collateral to keep positions open. If a bank is short tens of millions of ounces via futures and swaps, the call for extra margin can run into the billions, and it must be met in days or even hours. Treasury desks start cannibalizing liquidity from other areas, dumping bonds, equities, or other assets to raise dollars. Credit officers demand justification. Why are we so short? How quickly can we flatten? Traders know the honest answer. Flattening now, in a vertical market with poor liquidity, may be mathematically impossible without blowing through loss limits and triggering even more panic across clients and counterparties. What deepens the tension is that the bank OS short exposure is not confined to a single neat futures position on COMEX. It is the tangled result of years of business, selling unallocated silver to wealth management customers who never asked for bar numbers, providing price exposure to ETFs and products that track silver without holding every ounce in segregated form, financing miners by buying future production at discounts, writing options to industrial users who want price certainty, entering into swaps with other institutions who themselves are hedging other layers of risk. On paper, much of this nets out. In practice, under stress, every client with a claim to silver that is as good as physical starts to ask uncomfortable questions. If even a minority insists on delivering out, withdrawing from vaults, or converting unallocated to allocated metal, the bank's need to source real ounces escalates precisely when those ounces are least available. Amid this unfolding drama, a few stark facts about silver's dual nature become impossible to ignore. Silver is, historically, a monetary metal. For centuries it backed coins and functioned as a store of value. In the modern era, though, its primary demand has shifted to industry, electronics, solar panels, medical applications, and increasingly energy-related technologies. Annual industrial demand consumes a large fraction of mine output, and, unlike gold, much of the silver used in small electronic components is uneconomical to recycle. In other words, while the financial system has treated silver as an endlessly rehypothecatable line item on a screen, the real world has been quietly chewing through the available stock of easy-to-mobilize metal. As that reality collides with a leveraged paper structure during a sudden price spike, the theoretical abundance implied by derivatives is exposed as fragile. The banks who are now panic buying above 77 did not, in their own minds, set out to suppress silver forever or engineer their own demise. For years, they simply played the game as it was designed. They earned spreads by warehousing risk between producers and consumers, smoothing volatility, and offering investors tradable exposure. Regulators, too, were broadly comfortable with this arrangement, seeing it as part of the plumbing of global markets. But in this imagined morning, when silver rips through levels that had existed only in stress tests and feverish blogs, everyone is forced to confront the same uncomfortable question. If the price is screaming that something fundamental has changed, and the biggest players are now scrambling to get flat, who, exactly, is on the other side of this trade? And how much real metal is actually left to deliver? As the trading day wears on and the price refuses to retreat meaningfully below the mid-$70 range, the psychological balance shifts further. Earlier in the move, some participants may have viewed the spike as an overreaction, a blow-off top that would mean revert as soon as the shorts cleaned up their books. But the longer silver holds these new levels, the more it begins to look like a regime shift rather than a temporary squeeze. In that sense, the trapped feeling inside the banks is not only about this day's losses, it is about the prospect that their entire mental model of the silver market has become obsolete. The perfect storm that produced this moment was brewing for years, in macroeconomic trends, in energy markets, in geopolitics, and regulation. Only now, with a simple but shocking number on their screens, are the consequences fully visible. The second part of this story steps back from the screens and sirens of a $77 morning to explain how the financial architecture around silver evolved into something so vulnerable. Silver, unlike tech stocks or exotic credit derivatives, is about as old-fashioned a financial asset as one can imagine. For most of human history, value was literally weighed out in silver coins or bars. Yet in the late 20th and early 21st centuries, silver was drawn into the same process of financialization that transformed other markets. It began on the sensible premise that miners needed predictable revenues. Industrial users needed predictable input costs, and investors wanted cheap, liquid ways to gain exposure without dealing with physical storage. Futures exchanges, bullion banks, and clearing systems were the tools that made all of this possible. Over time, however, those tools layered claims upon claims, until the notional silver traded in a day dwarfed the physical that changed hands in a month. A central role in this architecture is played by bullion banks, often the same global institutions that dominate in currencies, government bonds, and derivatives. These banks operate unallocated silver accounts for clients. When a wealth management customer buys unallocated silver, the bank credits their account with a number of ounces, but does not set aside a specific bar with a serial number. The client has a claim on the bank, not on particular metal. The bank can then use the pooled silver in its own trading, lending, and hedging activities. In calm times, this works smoothly. Most clients treat their position as an investment, not a warehouse receipt, and few ever request large-scale physical withdrawal. The bank, confident in that behavior and its own risk management, feels comfortable with a maturity transformation, promising on-demand access to something it has, in part, lent out or sold forward. Parallel to these unallocated accounts operates the futures market, most prominently COMEX. A standard silver future obligates the seller, at expiry, to deliver 5,000 ounces of exchange approved silver to the buyer at the agreed price, unless the contract is closed or rolled before first notice day. In practice, only a small fraction of futures open interest ever results in actual delivery. Most are closed out or rolled as purely financial positions. That statistic has encouraged sellers, including banks, to view futures more as betting slips than firm delivery obligations. A bank might be short a large number of contracts to hedge other exposures, confident that it can buy them back gradually over time as liquidity ebbs and flows. The danger, of course, lies in the assumption that such liquidity will always be there at reasonable prices, an assumption which can be shattered by the kind of relentless, one-sided moves that define squeezes and panics. Then there is the London over-the-counter market, where much of the global silver trade is conducted via forwards and swaps rather than exchange-listed futures. The London Bullion Market Association, LBMA framework, allows big players to trade large volumes bilaterally, with settlement often in unallocated accounts. A mining company might enter a forward sale with a bank to lock in prices for production months or years ahead. A bank might then hedge that exposure with another institution, or with a combination of COMEX futures and physical inventory. Over time, these interlocking contracts create a dense web of obligations. On a net basis, the system may be close to balanced, but gross exposures can be enormous. Crucially, in a stress situation, gross rather than net is what matters to cash flows and collateral calls. Each line must be margined and funded until counterparties agree to compress or settle. The claim that there is far more paper silver than physical is not a slogan invented purely for dramatic effect. It reflects a measurable discrepancy between derivative exposures and deliverable stocks. Estimates vary, and sober analysts are careful not to accept the wildest ratios, sometimes repeated online. But even conservative calculations show that exchange inventories and quick-to-mobilize private stocks are a fraction of the ounces referenced in outstanding contracts and accounts. In normal times, this is manageable because not all holders want delivery. Many are content with synthetic exposure. Yet the comfort rests on trust. Trust that the system will always function, that counterparties will remain solvent, and that if one truly desires physical, it can be obtained within a tolerable band above spot price. Once that trust is eroded, especially in an environment of rapid price appreciation, the latent imbalance can turn explosive. Part of what makes banks especially vulnerable is that their business model incentivizes them to supply liquidity in the direction of maximum demand. When investors want to be long silver exposure, banks naturally end up short as they sell futures, swaps, or unallocated ounces. They may hedge some of that exposure by holding physical or going long in other contracts, but risk appetites, funding costs, and regulatory capital rules all push them toward running a net short book in many circumstances. Over years of range-bound or declining prices, this can be lucrative. They earn financing spreads, option premiums, and trading revenues while rarely facing existential challenges. The danger is that if the environment shifts dramatically and investor demand for long exposure surges at the same time as physical holders withdraw metal, the banks find their traditional role as liquidity provider morphing into that of shock absorber, taking hits that grow larger as prices move against them. Complicating matters further is the intersection of this structure with post-crisis regulations such as Basel III. These rules reshaped how banks must treat different assets on their balance sheets. Gold received special attention via the net stable funding ratio and other metrics that changed the economics of unallocated accounts and derivative positions. Silver did not receive exactly the same regulatory spotlight, but the general tightening of capital and liquidity standards encouraged banks to economize on high-quality collateral and to think carefully about warehousing metal. Holding large stocks of physical silver ties up balance sheet capacity and may be less attractive than running synthetic positions. Over time, this bias strengthens the drift toward a system where claims multiply faster than bars, leaving the underlying structure more exposed if, one day, bars rather than claims become the scarce item in demand. Historical episodes offer glimpses of how such tensions can erupt, even if they never reach the imagined heights of $77. The Hunt brothers' attempt to corner the silver market in the late 1970s and early 1980s pushed prices briefly to nearly $50 an ounce before crashing. That episode led to tighter position limits and greater regulatory scrutiny, but it also proved that, under certain conditions, silver could move with a violence that undermined assumptions across the financial system. More recently, in 2011, silver again spiked close to $50 during the post-crisis commodity boom. only to tumble as margin requirements were raised and macro conditions shifted. Each time, the lesson for banks seemed to be that squeezes can be ridden out, provided regulators and exchanges adjust rules and the broader environment cools. The unspoken risk is that there may come a time when those levers are less effective or politically viable. The years leading up to our hypothetical $77 print are characterized by slow, almost invisible changes that only look obvious in hindsight. Industrial demand for silver and photovoltaics and electronics ratchets higher as the world pushes toward electrification and renewable energy. Exploration budgets and new mine development lag because the sector has been starved of capital. Many deposits are low-grade or politically challenging. Recycling helps, but cannot fully plug the gap between potential demand and fresh supply. Meanwhile, monetary and fiscal policies in major economies oscillate between aggressive stimulus and belated attempts to rein in inflation, eroding trust in fiat currencies among a subset of investors and savers. These people, skeptical of both central banks and opaque financial products, steadily accumulate physical metal, often outside the traditional banking system. In parallel episodes like the 2020 meme stock and silver discussions on retail forums demonstrate that loosely coordinated crowds can, at least for a time, stress test the ability of institutional shorts to withstand sudden inflows of buy orders. While the much talked about silver squeeze of that period did not produce a lasting breakout, it did highlight the mismatch between visible inventories and the scale of potential retail demand if sentiment ever flipped decisively. Some ETFs and dealers briefly faced delays in premiums on coins and small bars, even when COMEX prices did not fully reflect that tightness. For the most part, banks and regulators dismissed these things as transient froth. Yet the memory lingers and sets the stage for a future in which similar dynamics are triggered in the context of far more serious macroeconomic strain. In this way, the silver market enters the crisis moment with a hidden fragility, a layered edifice of derivatives and unallocated claims, built atop a slowly tightening base of physical supply, all operating in a world where trust in financial promises has been chipped away. When one day, a confluence of factors pushes more participants to prefer tangible metal over exposure, and when that preference coincides with a surge of speculative and hedging demand driven by macro turmoil, the result is a bid for silver that overwhelms the usual dampening mechanisms. That is how an ordinary-looking market long thought to be tamed by modern finance can suddenly reveal itself as the site of a perfect storm, with the largest, most sophisticated players discovering that their familiar strategies have locked them into positions from which there is no easy escape. The third movement of this narrative dives into the mechanics of the trap itself, the sequence of financial events that transforms a difficult trading environment into an existential crisis for the short side. It begins with what appears, on the surface, to be a fairly standard commodity rally. Maybe it is triggered by a policy shock, such as an abrupt reversal by a major central bank that signals inflation will be tolerated for longer. Maybe it coincides with supply disruptions in key mining regions, or with trade tensions that interrupt flows through refineries and mints. Whatever the spark, silver starts to trend higher over a period of months, moving from the 20s into the 30s and then 40s. At each threshold, some shorts cover, some new ones enter, and speculative longs ride the wave. For a time, the dance resembles previous cycles, volatile but manageable. What changes this time is the behavior of those who actually own significant quantities of physical silver outside the leverage system. In prior rallies, a portion of long-term holders took advantage of high prices to sell or lease metal back into the market, providing the banks with supply to roll short positions and satisfy deliveries. But after years of erosion in trust toward governments and financial intermediaries, and amid rising geopolitical fractures, this cohort behaves differently. Central banks of certain countries, having quietly accumulated gold, now begin to diversify smaller amounts into silver as well, treating it as a complementary monetary reserve and a hedge against sanctions. High net worth individuals and family offices, burned in other asset classes, decide that their physical silver is a strategic holding not to be traded lightly. Industrial users, fearful of future shortages, sign longer-term supply contracts and are reluctant to sell any excess. The marginal ounce that, in previous cycles, would have been coaxed out of hiding by high prices stays put. On the other side of the ledger, the obligations of the short side do not remain static. As prices rise, value at risk measures increase, pushing risk committees at banks to demand either reductions in open positions or additional hedges. Yet, hedging a short position that has already moved against you can be like trying to patch a leaking roof in a hurricane. Buying call options to cap upside risk when implied volatility has already surged is extraordinarily expensive. Selling more unallocated silver to clients who still want exposure may bring in cash today, but it deepens the bank's long-term liability to source metal in the future. Rolling futures shorts to more distant months pushes the problem forward in time. But if the forward curve is in backwardation, meaning near-term prices are higher than distant ones, that roll can cost more with each iteration. What had been smooth, profitable position management in a gentle market turns into an exhausting, margin-consuming grind. At certain key price thresholds, the exchange and bilateral counterparties adjust margin requirements, both to protect themselves and to reflect the newfound volatility. This is where the trap tightens. A bank that, at $30 silver, needed a given amount of collateral to maintain its book might find that, at 50 or 60, it must post multiples of that amount. Collateral is not free. It is drawn from the same pool of high-quality assets the bank uses to support countless other activities: repo financing, swaps, client lending. Treasury desks are forced to decide whether to divert scarce collateral into supporting a bleeding silver position or to cut and run, crystallizing losses. If multiple banks are caught in similar binds, the pressure is not isolated. It ripples through funding markets with knock-on effects in seemingly unrelated instruments as firms sell whatever they can to raise cash. The market senses this vulnerability, even if it does not see individual position books. Price patterns, depth of order books, and the behavior of large blocks give clues. Nimble hedge funds and commodity traders, some of whom have long suspected that the silver market's paper structure could be exploited, press their advantage. They bid up near-month futures aggressively, stand for delivery in greater than usual size, and arbitrage dislocations between exchanges and physical markets. When the banks try to lean on the price with more selling, these players absorb the offers, either because they genuinely want the metal or because they anticipate being able to flip contracts at higher levels as the shorts capitulate. It is a classic short squeeze dynamic, amplified by the fact that underlying physical tightness makes it credibly dangerous for the shorts to simply ride things out. One important, if often misunderstood, twist is the role of exchange inventories labeled as registered and eligible. Registered silver is available to be delivered against futures contracts. Eligible silver meets the quality standards and is stored in approved vaults, but is not currently committed to the exchange for delivery. In times of stress, watching metal move from registered to eligible can signal that holders are withdrawing potential supply from the deliverable pool, perhaps in anticipation of better prices or because they distrust the system. As inventories in registered categories dwindle, the optics alone can exacerbate fears. Even if, on a broader global scale, there is still plenty of silver in aggregate, the specific ounces in the right form, location, and legal status to satisfy immediate delivery needs become scarce. For a bank facing the prospect of failing on delivery obligations, the temptation grows to do whatever it takes to buy those ounces back, regardless of price. Legal and reputational risks intensify the pressure. Failing to deliver metal promised under futures or unallocated account terms is not simply a matter of an embarrassing P&L. It can invite regulatory sanctions, lawsuits, and even questions about solvency. Wealth management clients who suddenly find that their silver is being cash settled at old prices rather than fulfilled in bars during a raging bull market are unlikely to take the news calmly. Industrial users, depending on silver as a critical input, may have contractual provisions requiring compensation for failure to supply. Central banks or sovereign funds that hold metal through large dealers would interpret any sign of weakness as a reason to reconsider those relationships. In such an environment, the imperative to avoid a technical default trumps almost all other considerations. The bank must get flat, or at least meaningfully reduce exposure, even if that means buying silver at increasingly painful levels. In our story, the $77 breakout is not the first sign of trouble for these institutions. It is the point at which their options narrow dramatically. Up to perhaps $50 or $60, they could still entertain hopes of a correction, still lean on the price with some selling, still believe that regulators might tweak margin rules in their favor or that macro news might dampen the rally. Above 70, with physical flows clearly tight, sentiment tilting toward hoarding, and their own liquidity under strain, the psychology changes. Every dollar higher not only deepens current losses, but also signals that the hoped for relief is receding. The scramble to buy back shorts, to secure any available supply, accelerates. Offers in size vanish from screens, replaced by smaller, cautious sell orders that are quickly lifted. The existence of forced buyers, known to the street, emboldens sellers to demand ever more aggressive prices. The trap, in this sense, is both mechanical and psychological. Mechanical because the structure of levered short exposure in a limited physical market means that, beyond a certain point, the marginal unit of demand must be met with increasingly scarce and expensive supply. Psychological because the players who might normally take the other side of the trade no longer trust that they will be able to re-enter or that fiat proceeds from selling will preserve their value. The banks, who once comforted themselves that they could always outweight speculators or overpower retail sentiment, come to realize that time is now their enemy. Rolling positions forward simply prolongs the agony. Decisive covering, while devastating in the short term, may be the least bad option. And as they move en masse to execute that covering, their bids become the fuel for the final violent phase of the squeeze. In this environment, even rumors acquire outsized impact. Whispers that a major bank is on the verge of a delivery default, or that a sovereign entity is quietly withdrawing its vaulted silver can spark waves of buying or refusal to sell. Central clearinghouses, seeing the risks, may tighten standards further, ironically increasing liquidity strain at precisely the worst time. Regulators and policymakers, always slower than markets, scramble to understand the situation, receiving conflicting advice from institutions that are themselves conflicted. Some argue for intervention to stabilize prices, others warn that meddling would only heighten distrust. All the while, the screen continues to tick. And on the floors where the pain is most acute, the only clear imperative is buy back, get out. Survive to trade another day. To grasp why this moment of panic, buying above 77 feels like a perfect storm rather than just a large, short squeeze. The fourth part of this story explores the broader macroeconomic and geopolitical forces that converge on the silver market. No market moves in a vacuum. For silver to climb to such heights and stay there long enough to entrap major banks, the backdrop must be one of persistent stress and structural change in the global financial system. Inflation is not just a brief spike, but a stubborn, politically charged problem. Governments, burdened with high debt levels after years of deficits, find it easier to tolerate inflation as a quiet form of default than to impose fiscal discipline. Central banks talk tough, but constrained by fragile economies and political pressure, repeatedly err on the side of easy money. Real interest rates, after adjusting for inflation, remain low or negative. In such an environment, the traditional safe havens of bonds and blue-chip equities lose some of their appeal. Savers looking to preserve purchasing power turn to hard assets, real estate, commodities, and monetary metals. Gold, long the primary beneficiary of such sentiment, attracts large flows, but its price rise eventually leads some investors to look for value in its historically cheaper cousin, silver. The gold-to-silver ratio, a popular metric among precious metals enthusiasts, begins to contract sharply as silver outperforms. What was once a sleepy, underfollowed market is suddenly flooded with fresh eyes and capital. Exchange-traded products that track silver see surging inflows. New vehicles are launched to meet demand. Each inflow creates new obligations somewhere in the chain to either acquire physical silver or to promise synthetic exposure, with the expectation that someone, somewhere, will have the metal if needed. At the same time, the energy transition accelerates. Ambitious climate targets spur aggressive deployment of solar power and electrification of transportation. Silver, with its exceptional electrical and thermal conductivity, is a critical component in photovoltaic cells, high-efficiency electronics, and certain battery technologies. Engineers and supply chain managers, under pressure to deliver on energy goals, increase their forward contracting of silver, unwilling to risk project delays due to material shortages. The elasticity of supply, however, is limited. Large-scale silver mines take years and huge capital investment to develop. Many existing mines are primarily focused on other metals, with silver as a byproduct, meaning their silver output cannot be ramped up independently of broader market conditions. Environmental regulations, local opposition, and geopolitical instability in key producing regions further constrain new capacity. Meanwhile, the geopolitical landscape grows more fractured. Rival blocs emerge, with one group of countries aligned around the traditional Western financial system, and another seeking alternatives to the dollar-dominated order. Sanctions, asset freezes, and the weaponization of payment systems convince many governments that they must hold some reserves beyond the reach of foreign central banks. Gold is again the primary choice, but silver benefits as a supplementary reserve asset, particularly for countries with less access to large quantities of gold or with significant domestic silver industries. These central bank and sovereign purchases are often opaque, conducted quietly through a handful of dealers and off-exchange transactions. To the outside world, they manifest less as a headline figure and more as a persistent, hard-to-explain tightness in available supply and a floor under prices during corrections. Layered on top of this is a trust crisis within the financial system itself. After successive scandals, crises, and bailouts, public confidence in leveraged, opaque institutions wanes. Depositors, investors, and even corporate treasurers grow more wary of relying solely on digital claims for their wealth. In response, some allocate a portion of their assets to physical stores of value. Cash, gold, silver, and, in some cases, other commodities held outside of bank custodianship. This trend need not be dominant to exert pressure. Even a modest shift in preferences among a relatively small subset of wealthy and institutionally powerful actors can significantly reduce the pool of metal willing to flow back into the paper system. When the banks arrive, metaphorically, at the door of that pool, seeking to borrow or buy back silver to meet obligations, they find it guarded by owners with little interest in short-term profits. Another important ingredient of the perfect storm is the gradual breakdown of the narrative that derivatives can always substitute for physical. For years, financial education and marketing have emphasized the efficiency of synthetic exposure. Why go through the hassle of vaulting and insuring bars when you can own a share of an ETF or a structured note that tracks silver price? That narrative assumes that tracking errors will remain small and that redemption mechanisms will always function smoothly. In a world where logistics, politics, and counterparty risks become more salient, those assumptions are challenged. Reports of delays in physical deliveries, widening spreads between futures and spot in stressed periods, and occasional force majeure declarations in unrelated commodity markets, such as energy or agricultural products, breed skepticism. Once a critical mass of actors concludes that only metal in hand counts, the game changes. All of these forces, monetary instability, energy transition demand, geopolitical fragmentation, and loss of trust, do not merely add linearly. They interact in nonlinear ways. For example, if a sanction event prompts a country to dump some of its dollar reserves and redirect into gold and silver, that action can influence inflation expectations, currency values, and commodity prices simultaneously. Higher energy prices, perhaps resulting from the same tensions, increase mining and refining costs, pushing up the marginal cost of silver production. As that cost rises, so too does the price range at which miners are willing to lock in forward sales, altering the dynamics of hedging and supply. Speculators, seeing these interconnections, begin to treat silver not just as a niche commodity, but as a macro instrument, a proxy for stress in the fiat system. The flows this attracts are larger and more persistent than the traditional precious metals community alone could generate. Within banks, these big picture shifts filter down into daily risk management decisions in subtle but relentless ways. Credit committees become more cautious about extending lines to counterparties in stressed regions, tightening liquidity in precisely those parts of the market where silver might have been mobilized. Compliance departments impose stricter due diligence on physical transfers, slowing down the movement of bars across borders. Internal models, recalibrated to reflect higher volatility regimes, signal increased capital charges for commodities trading businesses. Each of these is rational in isolation, but together they reduce the capacity of the dealer community to absorb shocks. The system's ability to arbitrage away dislocations, to smooth localized shortages with global surpluses, is degraded. By the time silver is pressing into the 60s and 70s in our scenario, the interplay of these forces has hardened into a new reality. The previously elastic supply of paper silver has become much more brittle. The banks are no longer confident that they can tap deep pools of leased metal or quickly find willing sellers of large blocks. The presence of politically driven, price-insensitive buyers, whether central banks, strategic industrial users, or ideological holders, means that dips are more aggressively bought. The once placid ETF creation-redemption mechanism, which allowed banks to arbitrage differences between ETF shares and the underlying metal, now operates under strain, with authorized participants wary of being caught short physical in a gap higher. In such an environment, a price of $77 is not a bizarre outlier. It is a logical consequence of cumulative imbalances. This convergence of macro and micro factors is what earns the label perfect storm. No single element, the industrial demand, the inflation, the distrust of banks, the geopolitics, the regulatory shifts, would alone be enough to trap the major players so thoroughly. Together, they remove the usual escape routes. The banks cannot simply wait out the rally because the fundamental backdrop supports sustained high prices. They cannot easily source physical because strategic holders are reluctant to sell and logistics are clogged. They cannot count on regulators to bail them out quietly because public distrust of backroom deals is high and any obvious favoritism toward large financial institutions is politically toxic. The very conditions that make silver attractive as a refuge asset simultaneously make it a uniquely punishing market for those who have promised more of it than they can quickly deliver. The final part of this exploration considers the possible endgames and broader implications of a world in which silver has broken through $77, banks are panic buying, and the perfect storm is fully upon the financial system. One path, often speculated about but rarely seen in reality, is an overt breakdown in the formal mechanisms of price discovery and settlement. If a major futures exchange or clearinghouse were to face a wave of potential delivery failures, it might declare cash settlement only, allowing shorts to fulfill obligations in currency rather than metal. This would arguably avert a systemic shock at the cost of confirming, in the most public way possible, that paper and physical silver are not equivalent. Holders who believed they had secured the right to bars at a given price would instead receive dollars at a settlement price that may or may not reflect the explosive premiums prevailing in the tight physical market. Such a move would not necessarily end the crisis. It could, in fact, deepen mistrust. Investors and industrial users might respond by abandoning exchange-based hedging, driving more trade into opaque bilateral deals, or conversely, out of the financial system entirely and into direct relationships with miners and refiners. Banks that had relied on the exchange as a central hub for risk management would find themselves dealing with a more fragmented, less nettable web of exposures. Regulators would face an unenviable choice: tighten rules to prevent future stresses, potentially hampering market functioning, or loosen them in the hope of restoring liquidity, at the risk of being seen as complicit in past mismanagement. Either way, the reputation of large institutions as safe custodians of commodity exposure would be damaged. Another, subtler path is gradual but profound repricing. In this scenario, the panic phase of forced covering above 77 eventually subsides as enough short positions are closed, and enough marginal holders decide the run-up has met their objectives. The price may retreat somewhat from its peak, but it does not return to prior norms. Instead, it stabilizes at a new plateau, perhaps in the 60s or 70s with bouts of volatility. Banks absorb heavy losses and conduct internal autopsies, trimming or reshaping their commodities businesses. Some players exit the silver market altogether or drastically reduce their willingness to run unallocated liabilities. Risk departments impose strict limits on shorting without matched physical. The market emerges thinner but arguably more honest, with a closer relationship between claims and actual metal. For ordinary people and non-specialist investors, the implications of such an episode are complex. On one hand, anyone holding physical silver prior to the spike would see a substantial increase in nominal wealth, at least on paper. On the other hand, the same macro conditions that propelled silver higher, persistent inflation, policy uncertainty, energy transitions, geopolitical tensions, would likely be causing stress in other areas of life: higher living costs, unstable employment patterns, volatile mortgage and credit markets. A world in which silver trades at $77 is unlikely to be a calm or comfortable one. Those who attempt to chase the metal after the fact, drawn in by headlines of bank losses and dramatic charts, would be taking on significant risk in a market that has already demonstrated its capacity for violent moves both up and down. For policymakers, the spectacle of systemically important banks scrambling to cover positions in a metal once considered peripheral to mainstream finance would be a wake-up call. It would force a reassessment of the assumption that derivative markets inherently spread and reduce risk. They do, up to a point, but only if underlying collateral and physical markets are robust and trustworthy. When too many promises are written against too small a real base, derivatives become amplifiers of stress rather than cushions. Regulators might respond by imposing stricter ratios between unallocated and allocated holdings, clearer disclosure requirements for commodity exposures, and perhaps even capital surcharges for certain types of leveraged short positions. These changes would not undo the pain of the crisis, but could alter the trajectory of future market structures. Internationally, a silver spike of this magnitude could accelerate ongoing shifts in the monetary order. Countries that had already been diversifying reserves into hard assets would feel vindicated and might deepen that strategy. Others, caught unprepared, would be forced to reconsider their reliance on purely financial claims, denominated in currencies vulnerable to inflation and policy whim. Discussions about new settlement systems, currency blocks, or even commodity-linked trade arrangements would gain urgency. Silver, often overshadowed by gold in such strategic conversations, might enjoy a renewed status as a secondary reserve asset, especially among mid-sized economies or those with large industrial use cases. That, in turn, would institutionalize some of the demand that drove the original price spike, making elevated levels more sustainable. Within the banking sector, scars from the episode would shape culture and governance for years. Careers would end, new risk frameworks would be written, the mythology of invincibility around certain institutions would be punctured. Future generations of traders and executives would be taught cautionary tales about the time silver blew up the book. In some firms, that would translate into a healthier respect for physical constraints and for the dangers of treating real-world commodities as merely numbers in a ledger. In others, it might simply push risk-taking into less well-understood corners, as the innate human drive to lever and arbitrage finds new outlets. The lesson that risk does not vanish but merely migrates would apply here as it has in every prior financial upheaval. On a more philosophical level, such a silver episode would highlight the tension between abstraction and reality in modern finance. The entire edifice is built on the idea that claims, contracts, and models can represent and manage the messy physical world efficiently. For the most part, they do. But every so often, a stress event reminds participants that there are hard limits. Barrels must be shipped, grains must be delivered, metals must be refined and assayed. You cannot indefinitely promise more of a thing than exists in convenient, accessible form without, at some point, confronting the constraint. In our hypothetical, silver at 77 and banks panic buying is that confrontation made visible. It is the moment when the abstraction of paper claims collides with the finiteness of the underlying metal, and the mismatch is priced in with a vengeance. Finally, for individuals trying to make sense of such a world, one sober takeaway stands out. Markets can stay seemingly stable for long periods, encouraging the belief that certain patterns, like range-bound silver prices suppressed by powerful actors, are permanent. Yet beneath that surface, slow changes in technology, politics, geology, and human trust accumulate. When those changes line up, what appeared impossible, for instance, a silver price that renders decades of risk models obsolete, can arrive in a rush. In that sense, the story of banks trapped and panic buying as silver breaks 77 is less a sensational outlier than a case study in how complex systems fail. It underscores the importance of understanding not just prices and charts, but structures and incentives, and of remembering that no financial promise is stronger than the real-world capacity to honor it when everyone comes knocking at once.